Hello everybody and welcome to my channel. Today I will introduce you a very simple strategy which is named momentum, which can generate a tremendous amount of value. I will explain the model theoretically and then I will provide you my personal choice of an ETF which is generating impressive return year after year. Let's start! Managing momentum. Momentum is one of the most famous and commonly applied strategies in the field of investing. But there is huge confusion about it, and that's because it's used in a different formulation by both traders and portfolio managers. Here, in this presentation, I follow the asset management approach, and I will decline it through the very famous paper written by Pedro Barroso and Pedro Santa Clara, which was published in 2015 in Journal of Financial Economics. The paper is named Momentum Has Its Moments and is extremely fascinating because it boosts dramatically the already high performance of the momentum strategy. Now, what is momentum? Putting is as simple as possible. Momentum is a strategy which implies buying winners and short selling losers. And for winners and losers, it implies stocks which experience positive or negative returns in the past. Now, how can you implement it? The most commonly employed formulation is based on 4 steps. First of all, rank stocks based on their cumulative returns for 12 months before the 1 month before the formation date. So basically, what you're doing is taking the last year of daily returns and using the 12 months, but not the last one, in order to find the best stocks for your analysis in terms of positive and negative returns generated during that horizon. So, in order to find the so-called winners and losers. Second, leave a 1 month gap between the end of the ranking period and the start of the holding period to avoid the short-term 1 month reveals. So this means that you're not taking the last month of available data, but only the 11 months before this month. Okay? After that, step number 3, all firms and then placed into one of the 10 decile portfolio based on their ranking, where portfolio 10 represent the winners and portfolio 1 the losers. This is extremely important. So you basically forming 10 portfolios, ranking stocks from the best to the worst, and you're basically including the best in portfolio 10 and the worst in portfolio 1. Okay, so let's say top percent of your winner stocks are in portfolio 10 and top percent of your loser stocks in portfolio 1. And to create the momentum strategy, you need to use only portfolio 10 and portfolio 1. After that, you have to short the portfolio losers and buy the portfolio of winners. What you are betting is that the loser will continue to underperform the winners. And this effect is well documented, is robust, and is occurring on average year after year. And the winner decile excess return average 15% per year, and the loser portfolio average minus 2,5. In contrast, the average excess market return is 7,6. I'm saying that basically you can create a portfolio which is generating more than 17% per year, okay? Just with a plain vanilla strategy. And data show that this holds from 1927 until 2013. The effect is continuing from the very far past until today. But the problem with this strategy is that it suffers for massive losses, extreme negative returns of -70, -80%, which happens during period of financial turmoil. So it's a strategy which is on average is extremely profitable, but it had some terrible months. And that's what stops many investors to implement it in real world. Let's see the solution proposed by Barroso and Santa Clara. They use an estimate of momentum risk to scale the exposure to the strategy to have constant risk over time. So basically what they are doing is to fix a volatility target, forecast volatility. You can use simply the VIX index to have a proxy of expected volatility, and then you can scale your exposure toward your momentum strategy. I highly encourage you to implement this strategy following the approach of Barroso. It works. But I recommend common investors who are not sophisticated, who don't have years of experience in the field of portfolio management, to implement this strategy in the easiest possible way, and is to buy an ETF. An ETF is a fund doing the strategy for you. So you don't have to do anything. You have simply to buy it and to wait for the returns to come. But you can further boost the performance of your strategy by implementing the strategy proposed by Barroso and Santa Clara. So basically, what I recommend you to do is to trade the ETF on the momentum factor. Is everything for now. Thank you very much for your attention. If you have any other question, please send me an email at pisatimatteo@gmail.com. I will organize webinars where I will cover the elements introduced here in greater detail, and I will provide you a tons of insights about how to implement step by step the strategy we have seen. Thank you very much. Bye bye.